Hi guys, welcome back to Tax Q&A. It's that time of the year again. Tax season is officially here. And if you are someone who's filing their ITR for the first time, it can feel a little overwhelming. There's all this jargon, this form, that form, different schedules and whatnot. That's exactly why we are here today, to answer all the questions people usually have when they're filing their ITR for the first time. So let's get started. Okay, so think of ITR like a report card, but for your income and taxes. Throughout the year, we earn money, right? Maybe from jobs, freelancing, or investments. And on some of that income, tax gets deducted automatically, while for others, we keep on paying along the way. Now, at the end of the year, the tax department wants to see how much you earned in total, how much tax was already paid, and whether that was the right amount. That's what you do when you file your ITR. Oftentimes, a lot of people, especially those who are salaried, think that tax is already getting deducted from their salary every month, so they don't need to do anything else. Well, that's not true. Paying tax and filing your ITR are two different things. Filing your ITR is like officially informing the department, here's how much I earned this year and here's how my tax situation looks. And it's not just for the government. Your ITR is a super useful document. It serves as an income proof and is often needed when applying for loans, visas and more. Yes, an obvious question to ask. So for most of us individual taxpayers here, the due date to file the return is 31st July of the assessment year. Say for income earned in FY25, that is 1st April 24 to 31st March 2025, the due date will be 31st July 2025. However, only for this year, the ITR filing deadline has been extended to 15th September 2025. Now what happens if you don't file your ITR on time? Penalties of course, and you won't be able to carry forward losses or switch tax regimes. Don't make this mistake. Alright, if you're filing your ITR for the very first time, the first step indeed is creating an account on the income tax portal. Here's how you do it. First, head over to incometax.gov.in. That's the official income tax e-filing portal. On the top right, you'll see an option that says register. Click on that. Now add your PAN, some more details like name, date of birth, address, and so on. Once that's done, you'll get an OTP on your phone and email to verify your details. After verification, you'll set a password and the account is ready. But wait, don't stop there. Once your account is set up, one important thing that you should do is add your bank account details and pre-validate them. This is important because if you're eligible for a refund, that money will be credited to the bank account you've added here. To do this, click on your profile name at the top right corner and select My Profile. Within your profile, click on My Bank Account, add the details and validate. You're all set now. So the most common documents that you would need include your basic IDs like PAN and Aadhaar, then your Form 26AS and AIS. Both of these are available on the income tax portal. Now Form 26AS is like your annual tax statement. It shows all the taxes paid against your PAN during the year, like TDS deducted by your employer or bank, any advance tax you paid, or self-assessment tax. AIS or Annual Information Statement includes data like interest earned on savings accounts, dividends, and details of securities or property transactions. It's important to cross-check your incomes against the AIS to avoid any mismatch notices later. Now, depending on your income sources, you will need a few documents. Say if you are salaried, Form 16 is key. It's issued by your employer and shows your salary details plus TDS deducted. It comes in two parts. Part A shows TDS details, while Part B breaks down your salary and deductions claimed. If you have capital gains, say you sold a property or stocks, you will need the sales and purchase deeds for property and a tax P&L from a broker in case of stocks. Thirdly, if you earn from business or profession, you will need your balance sheet and P&L statement, plus receipts for expenses you want to claim. Finally, if you're filing under the old regime and looking to claim expenses or deductions, it has become a little difficult this year. The government is asking for a lot more details, so make sure you have your rent receipts, loan statements, insurance policy receipts, and other investment proofs handy. An important thing, these documents are mainly to help you fill in the details accurately. You don't need to submit them when filing your return, but keep them ready anyway, because if the department asks later, you will want to have everything in place. Okay, so there are basically four main ITR forms you might use as an individual, and which one you pick depends on your income sources. Broadly speaking, ITR 1 and ITR 4 are designed for small taxpayers with straightforward income, mostly salary and a few other basic sources like interest. Also, this year onwards, you can include long-term gains from stocks or equity funds up to 1.25 lakh taxable under Section 112A in ITR 1 and ITR 4. In both cases, your total income should be below 50 lakh. The key difference is that ITR 4 also covers people who have opted for presumptive income from business or profession. This means you're not maintaining detailed books but paying tax on a presumed income. If you want to understand what's presumptive taxation and how it can help you save time and money, you can check out this video. We'll put the link in the description. Now let's say your total income exceeds 50 lakh, or you've made gains from selling capital assets like property, stocks, crypto or gold. Then ITR 2 is the form for you. And finally, we have ITR 3. It's the most comprehensive of them all. Specifically, it applies to those who are earning from business or profession, people like freelancers, consultants, content creators, doctors or cafe owners. ITR 3 also covers other income sources and lets you declare say salary, business income, capital gains and even house property income all in one place. There are more conditions attached to each form and I've tried to list them all in this table, so you can refer to it anytime. I've also created a quick cheat sheet if you're earning from the stock market. Just match your income combination in the table and you'll know exactly which ITR form you need to file. You can take a screenshot of this table for reference. Again, a super common question. See, the government currently offers two tax regimes and the main difference is in how the tax slabs and rates are structured. The old regime has higher tax rates but lets you claim a bunch of deductions and exemptions, like investments, insurance, home loans and more. On the other hand, the new regime comes with lower tax rates but does not allow most of these deductions. The idea is to simplify things by giving you a straightforward lower tax rate instead of chasing deductions. For this assessment year, here are the tax slabs and rates for both regimes. Now to decide which works best for you, add up all the deductions and exemptions you usually claim and then use this table to see how much deductions you need at your income for the old regime to be beneficial. If you have more deductions than the break-even amount, go for old regime or else new regime it is. One more thing, the new regime is the default option. So if you have business or professional income and want to switch back to the old regime, you will need to file Form 10 IEA to notify the tax department. But if you are filing ITR 1 or 2, you can switch between regimes easily without that form. Well, you can choose from a few options. Number 1, you can file it online on the income tax portal. For this, log into the portal, select the assessment year, type of return and ITR form. Then select the schedules applicable to you and fill in the data step by step. Number 2, very similar to the previous method, you can use the offline utilities provided by income tax. You can download the utility from the portal, then fill out the ITR offline and then submit once it's done. And if you're looking for a simpler way to file without juggling too many documents or forms, platforms like Quicko can really help. It pulls together your details from places like Form 26 AS and AIS and even your stockbrokers, so you don't have to dig through the papers and forms. Plus it walks you through each step, does the math for you and takes a lot of the stress out of filing, especially if it's your first time. Actually, you don't need to follow any extra steps to claim a refund. If you have paid more tax than you should have, the extra amount will be automatically refunded to you after you file the ITR. Just make sure your bank account is pre-validated and nominated for refunds on the income tax portal. So you receive a refund once your ITR gets processed. Usually, if everything is in order, returns get processed in 7 to 10 days after your ITR is verified. But a few things can slow it down. Say if you delay e-verifying your return, if your refund bank account is not pre-validated or nominated, if there's a mismatch in income or TDS reported, or if your return goes under detailed scrutiny. Even if everything is right, sometimes the department might take longer to process a few returns. So based on the last few years of helping people file returns, here are a few mistakes that pop up most of the times. Number 1, not checking AIS and Form 26 AS. This one's big. These two have all your income and tax details. If you miss something that's reported here, you could either lose a refund or get a mismatch notice later. Second, not reporting interest income. Even if interest from your savings account or FDs is partially exempt, it still has to be reported. Especially with FDs where interest may not hit your account every year, but TDS is still deducted annually and hence reporting is mandatory. Number 3, forgetting foreign assets or unlisted shares. If you own ESOPs in a US company or invested in an unlisted company, you need to report them even if you have not sold anything. Number 4, not comparing tax regimes. Yes, the new regime is the default now, but if you have got deductions, say home loan, ELSS or HRA, it's still worth comparing with the old regime once before filing. And lastly, forgetting to e-verify. Filing is only half the job. No, actually 99% of it. But this one little step is very important. You have to e-verify your return within 30 days or it won't be processed. It's just a quick OTP and you are done. I understand, with so many details to fill in added with the end moment rush, It's possible to make some mistakes or miss out on any important information. But don't worry, it's not the end of the world. You can do two things. One, if you have not e-verified your ITR yet, you can discard it and then file a new return altogether. Simply log into the e-filing portal, navigate to e-file, income tax returns, e-verify return and discard. Now if you have already e-verified the return, the second option is to file a revised return. This return is filed under section 139(5) and the information you disclose here will be considered over your original return. Remember, you will have to again e-verify the revised return within 30 days of filing it, and the due date to file a revised return is 31st December of the assessment year. And with that, it's a wrap. If Google search is too much work for you, Quora is full of opinions, and ChatGPT is not accurate enough, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one.